Well, we're going to go ahead and get started. We don't have any participants yet joining us with this study session, but I'm going to go ahead and start walking you through the practice problems for Chapter 3. First question, QS 3-7. It says Lopez Company paid $1,200 for 6 months of insurance coverage. No adjustments have been made to that account, and it's now the end of the year, December 31st. So what you have to do is you have to look at how many months are involved, and that is 6 months. Just so happens that equally matches up between July 1st and December 31st. So we're going to make an adjustment for the full amount. First thing we're going to do is we're going to list the debit. The debit in this case is insurance expense, and that's going to be $1,200. All right. And next, it's going to be a credit to prepaid insurance. You see, we created that prepaid insurance account when we bought it, and that was a debit then. But to reverse it, now we have to do a credit. So let me see if I can find it here. Prepaid insurance, $1,200. Okay, next. We have to record the supplies that were used during the year. So we had $5,000 of supplies at the beginning of the year. We bought another $2,000, so that brings us up to $7,000. And then we're going to subtract our ending inventory of $800. And that's going to show that we used $6,200 in supplies. So our debit is going to be supply expense. And our credit is going to be supplies. Because remember, every time we buy supplies, we debit that account. We're going to reverse it now. And $6,200 goes in each entry so that we remain in balance. Check our work. And it's messing up on me already, so bear with me a minute. And it erased it. Oh well, those were correct, by the way. So you can take that to the bank. And it doesn't want to advance now. We seem to be experiencing technical difficulties in student mode. Maybe I have to get back out of this somehow. No? Try this. There we go. All right. So again, we're staying with adjusting entries. Barga Company purchased $20,000 of equipment. Equipment was expected to last 5 years and be worth $2,000 at the end of this time. So we're doing depreciation here, okay? We're going to spend an entire chapter on this, but I'll give you the quick and dirty of it. We can assume that it is straight line depreciation. So we're going to take the $20,000, divide, and we're going to subtract 2,000. That gives us 18,000, because we have to subtract out the salvage value, and that's what that $2,000 is. So 18,000 divided by 5 is $3,600. Okay. And so that's going to be our adjusted entry. So we're going to have a debit of depreciation expense equipment. And we're going to have a credit of accumulated depreciation equipment. And both will be $3,600. Right. Requirement number 2. Welch purchases $10,000 of land on January 1st. Land is expected to last forever. We never depreciate land. So that's going to be the correct answer. I don't know what will show up here. No journal entry required. There you go. Because we never depreciate land. Next, there's we got 3 different adjusting entries. The first one is unearned rent revenue. Drug company collected $6,000 in rent in advance on November 1st, debiting cash and crediting unearned rent revenue. Tenant was paying 12 months in advance. So if it's on November 1st, it means we got 2 months left, right? And how much is, and it's paying 12 months in advance. So that's $500 a month. Divide 6,000 by 12, that gives you $500 a month. So if we take 2 months times $500, because November and December is 2 months, times 500, that means we're going to have $1,000 adjusting entry. Okay. And so what we're going to do is we're going to debit unearned rent revenue, $1,000, and we're going to credit rent. Wait a minute. Did that wrong? I apologize. No, I'm sorry. We're going to credit rent revenue. I did it right. Rent revenue, $1,000. So your debit's going to be unearned rent revenue. That's going to reduce the balance in the account by $1,000. And we're going to credit rent revenue. Requirement 2. Company charges $75 per insect treatment. Company paid $300 on October 1st for 4 treatments. So that's going to mean $75 per treatment, right? Which was recorded with a debit to cash and a credit to unearned service revenue. At year end, the company has applied 3 treatments for the customer. All right. So we're going to see what that account is going to be. Flipping too fast on me. Let me go back to the top here and see if we get a clue in there. Debit to cash, credit to service revenue. Okay, so our debit is going to be, I'm sorry, I didn't know we were the company that was charging it. So we're going to debit unearned service revenue. And we're going to credit service revenue. And that'd be $225. Okay, number 3. Client paid the company $24,000 in cash for 6 months of rent in advance. So 24,000 divided by 6 is 4,000 a month, and took occupancy immediately. The company recorded the cash as unearned rent revenue. So, so if it's 4,000 a month, on September 1st, we have September, October, November, December. That's 4 months. 4 months of rent is $16,000. So we're going to have a debit of unearned rent revenue, $16,000, and a credit of rent revenue, $16,000. And we got it all correct. Okay. Next one, problem number 4. For each case, record the adjusting entry again. Lonzo Company receives $3,000 in cash for 6 months of recycling services. So that's $500 a month. Yeah, 3,000 divided by 7. And let's see, they provide recycling services. Promise, prepare the December 31st year-end entry. September through December, 4 months. Okay, 500 a month. So that's going to be $2,000 that we're going to have to adjust out. So again, debit under revenue. $2,000. And we're going to credit revenue. Well, wait a minute, let's go back. Something's wrong here. I think I know what it is. This is one of them trick questions. Well, there should be a, oh, there it is, service revenue. I'm sorry, I missed that. I thought it was one of those gotcha questions where they tried to say that it was on account. Okay, record recognized revenue from ticket sale of 4 of 10 games played. So, Milwaukee Bucks sold a 10-game ticket package for $200. So that's $20 per game. And recorded as unearned revenue. December 4th, by December 31st, 4 of the 10 games have been played. So we have to record the journal entry. So we're going to debit ticket revenue, $80. And we're going to, I'm sorry, not the ticket revenue, unearned ticket revenue. And we're going to credit ticket revenue, $80. Let's check our work. And we got it right. All right, next. So record the adjusting journal entries for each case below for the year ended December 31st. Salaries payable at year end, a salary expense of $15,500 been incurred, but not yet paid to employees. So salary expense, let me check to make sure. All right, so we're doing the adjusting entry to capture that. So we're going to debit salary expense, and we're going to credit salaries payable. Next one. Company owes $250 interest on a loan. The interest will not be paid till sometime in January. So we're going to debit interest expense, $250. And we're going to credit interest payable, $250. Let me make sure I typed in the numbers on the last one. Nope, I didn't do that. And number 3, year-end company holds a mortgage payable that has incurred $875 in annual interest. That is neither recorded nor paid. The company intends to pay the interest on January 7th. So your debit is going to be interest expense, $875, and interest payable will be our credit. That's how we carry things over in the next year, by putting them in a payable account. Now, next, Molly Mocha employs one college student every summer in her coffee shop. The student works 5 weekdays and is paid the following Monday. The coffee shop makes an adjusting entry each month to show salaries earned but unpaid at the end of the month. Student works the last week of July, which is Monday, the 28th through Friday, August 1st. So you got 4 days here. She's working in July, 28, 29, 30, 31. 4 times $100 per day is $400. Okay, so we're going to debit salary expense $400. And we're going to credit salaries payable. We haven't paid her yet. $400. Oh, so I hit the wrong one. I selected supply expense instead of. Yeah, I do that a lot. I think I'm clicking on one and the other pops up. But we know that the correct answer is salaries expense. All right. Record adjusting journal entries for each separate case. Accounts receivable. Year end, L. Coal Company has completed services of $19,000 for a client, but the client has not yet been billed for those services. All right. So what we're going to do, they've completed the services now, but they haven't paid anything. So we're going to have a debit to accounts payable. Receivable, I'm sorry. And that would be of 19,000. And we're going to have a credit to service revenue, because we earned the revenue in this period, so we have to capture in this period. Number 2, year end, the company's earned but not yet recorded $390 of interest earned from its investment in government bonds. So our debit is going to be interest receivable, because we earned it, but we haven't received it yet. And our credit is going to be interest revenue, $390. Next, painting company bills customers when jobs are complete. The work for one job is now complete. Customer has not yet been billed for $1,300 in work. So again, it's going to be accounts receivable, $1,300, debit. And we're going to record the revenue. Service revenue, $1,300. Let's check our work. And we're all correct. All right, the following unadjusted balances, along with year-end adjustments for Quinlan Company, complete the adjusted trial balance by entering the adjusted balance for each of the accounts. So there are no adjustments for cash, so that's a debit to cash. That equals the same entry in the beginning. There is an accounts receivable 2 entries. There's a beginning balance, and there's adjustments, so that's going to be 6,000 is the new balance in the debit column. Next one is supplies. We have a debit balance of 4,500, and then we have an adjustment in the credit column of 2,500. So new balance is going to be $2,000. We had no beginning balance in salaries payable. We have an ending balance of 400, and that's going to be a credit because it's salaries payable. Common stock has a beginning balance, a credit balance of 3,000. That's not going to change. Retained earnings has a credit balance of 6,000. Right now, that's not going to change. May later, but not now. Consulting revenue had a beginning credit balance of $11,000, and there's an adjustment entry of 4,000. So now that's going to be put in at 15,000. Salary expense, we have beginning balance of 5,500, and we have a debit of 400, so that's now 5,900. And finally, supply expense has a debit balance. It had started off with 0 and now has a debit balance of 2,500. And that's how you do your adjusted entries. And let's check our work. All right, next. Next, we're going to prepare the financial statements for each. Now, you've done these before. Let me look here for a second. I do not see any gotchas. In fact, everything is in the exact order which you need it to be. So, from when you do your first one, which is the income statement, it's all together right here at the bottom, like it has been for the prior 2 chapters. Let's see what requirement B is. Probably statement of retained earnings. Yeah, you should know how to do that. It tells you that the account balance was 24,600 of the prior year. So now you just have to add in the your net profit and then subtract out your dividends like you did before. I'm not going to go into detail on this because you've done it before. And then you put together your balance sheet. And again, everything's given to you up here, except you're going to have to put in the new retained earnings. Now we have something called closing entries. All right. So I'll walk you through how to do each one of these. Now, closing entries, as you should know by now, because you should have read your chapter, should have done your smart book. This is where we close out the income statement accounts and the dividends. And what this does is it generates what we have in the retained earnings account for the closing balance sheet. Okay. So first one we're going to do is close out the revenue account, and we have 9,500. So to close out the revenue account with a balance of 9,500, we're going to debit revenue. Just somewhere here. Yeah, consulting revenue. Okay. And then we're going to credit income summary. That just moved consulting revenue over to the income summary account. So now consulting revenue is 0 going into next year or the next accounting period. All right. That money's now parked in income summary. So next we're going to do expenses. And I'll have to add these up. So the expenses are 60, no, they're $7,000. All right. Now we need to do them like one at a time. So let's see what we got up here. Wages, depreciation, insurance. Let's see, 35, 2015. Oh, I did something wrong here. This is going to be to the income summary account. That's going to be our debit. Okay, depreciation is $215.35. Okay, so what we're doing in this is we've got to bring the expense accounts down to 0 going in the next period. Their normal balance is a debit. So we're going to credit whatever the current balance is in those so that we can bring them down to 0. Then we have to move that money over to the income summary account. Okay, now this income summary account, it only lasts as long as it takes to zero out everything. And then it itself gets zeroed out till next year. Okay, or till next month when you need it again to run all these accounts down to zero. Now we have to close the income summary. All right. So we're showing a balance in revenue. Well, income summary has a credit balance. Let me go back and see what it was. 9,500. So we have to debit that out to close this out to zero. And then the next is $7,000. So this is going to be income summary. And this is going to be income summary. Well, actually, no. I believe this would all be retained earnings. I'm sorry. I haven't done this in a while, so it comes back to me slow. Yeah, if you look at this, they don't equal each other, do they? Okay. So bear with me a second. I've got to pull something up here. Okay. Yeah, I got it wrong. All right. I was thinking we had to list those full amounts, but we don't on this. So what we're going to do is we're going to debit income summary. Where you at? $2,500. Now, if you look at back, we had $9,500 and $7,000. The difference was $2,500, but it was a credit balance because revenue exceeded the expenses, right? Now we're going to close out income summary credit retained earnings $2,500. So if there's a retained earnings balance there, that is going to get increased by $2,500 carried in the next year. Okay. All right. And then finally, we got to close out dividends. Now, what do dividends do? They decrease equity when they get paid out, right? So number 4 is we are going to debit retained earnings because we're going to be lowering retained earnings by paying out the dividends. And we're going to credit dividends. Because right now that's sitting in there with a debit balance. If our work. And we got it correct all the way through. Almost didn't on that number, on that third one. But we finally got it together in the end. So this is what, how you should answer this problem. It's set up there like that. All right, next, analyze closing entries on retained earnings. ACE company reports revenues of $40,000 and expenses of $31,000. Company paid $5,000 in cash for dividends. And after closing entries are recorded, determine the amount of increase or decrease in the retained earnings account. So with revenues of $40,000 and expenses of $31,000, that means you had $9,000 of net income. All right. If you paid out $5,000 in dividends, that left you with $4,000 as your increase in retained earnings. So we're going to be increasing retained earnings by $4,000. Let me repeat this again. You take the $40,000 minus the $31,000, that gives you $9,000. You're paying out $5,000 in dividends during all these transactions. So you subtract that from your net profit, and that leaves you with $4,000 that are going to sit in the retained earnings account in addition to whatever's there. Okay. All right, next we have to indicate whether or not it's included in the post-closing trial balance. So, accounts receivable, yes, permanent account. Here's where we have to determine whether or not these are permanent or temporary accounts. Permanent accounts are what's on the balance sheet. Temporary accounts are what's on the income statement, all right? Salary expense goes on the income statement, so that is not that doesn't go on the post-closing trial balance. Cash, yes, it does. Land, yes, it does. Income tax expense, nope. And salaries payable, yes. And we'll check our work. And we're good. All right, so now we have this company reported net income of $48,025, net sales of $425,000 for the current year. Compute the gross profit margin. All right. So numerator in this is going to be net income divided by net sales. Now we'll learn what net sales are soon enough. Just know that that's what the formula is for now. So you're looking at 48,025 divided by 425. And your profit margin should be 11.3%. On the next requirement, assume whose competitor has a profit margin of 15%. Who's generating more profit? That's easy. It's competitor. Got a higher profit margin. In this case, the bigger the number, the better. All right, number 14, we got to compute the current ratio. So what's in the current ratio? Well, it's accounts receivable. And then now this is for assets first. You do assets first. All right. The current assets, I'm going to select that first, and then current liabilities. So if we add up all the current assets, all right, which is going to be accounts receivable, cash, that gives us 25,000. Prepaid insurance and office supplies, that's going to give us a total of 30,800. Current liabilities. Let's see. Current liabilities, I think we only have one. Accounts payable. No, we have unearned service revenue too. So that's $14,000. And that gives us a ratio of 2.2. What this means is they have twice as many assets as what they need to pay off all their current liabilities. Check for work. And we're good. All right, number 15. On December 7th, Oklahoma City Thunder sold a $90 ticket to a basketball game to be played in March. So A, sale ticket to a basketball game, revenue to be recognized in November. This is not a drop down. So I guess we're going to have to put in numbers here. And so that's going to be 0. Because they haven't played the game yet. They're going to play it in March. We recognize the revenue when the service is actually provided. Next, Tesla sold and delivered a $58,000 car on November 25th. What's going to be, customer will not pay till February. Well, they're going to become an account receivable, but we still record the revenue of $58,000. Contract to provide advisory services. So Lloyd signed the contract November 1st to provide 40 days of advisory services with the receipt of $10,000 due at the end of the contract. As of December 31st, 75% of the services have been completed. So you're only going to record what's been completed. 75% of 10,000 is $7,500. And check our work. It's all correct. The Pulte has monthly wage expense of $3,200 that's been incurred but not paid as of December 31st. All right. Wages incurred but not paid. Well, they do get recognized in December. United Airlines purchased a 24-month policy for $48,000 on December 1st for immediate coverage. Okay, so we divide that by 24, that's $2,000 a month, but we only have 1 month to capture because that's all that's in this year. So the answer, that's going to be 2,000. Again, 48,000 divided by 24 is 2,000. That's, since we only have 1 month to cover, the answer is $2,000. December 15th, Pfizer prepays $20,000 for hotel rooms for its January sales. Okay. That's going to be a prepaid. So we're going to record 0. Can't capture it until the month actually gets here. So, all right, I'm going to leave this one for you because you've already covered this information before. It's just going to require a lot more work. Interesting enough that we're still recording everything in the order. So a lot of this stuff, you can just carry it down in the order on which it is. Up here, you have your assets, have your liabilities, have your equity section, and you have your income statement. So I'll leave that for you all to complete. Of course, you can ask me any questions by email you might have on those. And I'll leave this last one too, because this is going to be a lengthy one for you to complete. So I'll go ahead and this explains it in pretty good detail. If you have any questions, feel free to reach out to me. Okay. You're going to be prepare the adjusting and closing entries based on what the information that you have up here. And well, anyway, you just follow through the different tabs to get to where you want to be. You have the general ledger, trial balance, income statement, statement of retained earnings, balance sheet, and post-closing. Okay. You all have a good week. Good luck with the information. And don't forget to reach out to me should you have any questions.